Now we're going to come to the other part of section, that is ROI, which is return on investment. So first of all, what is a return on investment? As the terminology itself suggests, you're going to invest a particular amount, you're going to invest some time and resources in a project. What is the return you expect to get from the project? And that return you're going to quantify it into mathematical terms, okay? So it has to be something which is quantifiable. The return which you get has to be something quantifiable. Now, many times projects are undertaken with the intention of non-financial returns also, like brand value enhancement, goodwill creation, and making people aware of your company's product and all those things, which ultimately lead to obviously increase sales, increase revenue, increase profitability. But the intention of a particular project may be to enhance the non-monetary, non-financial factors for a company. But we're going to restrict ourselves only to the financial factors and understand how do companies evaluate the ROI, the return on investment, and take decisions accordingly. So, to summarize, what is an ROI? It is just the return which you expect to get on your investment, which is quantified in a mathematical terms for a financial understanding. Okay. So this was not a standard definition. First of all, by the way, this is something which I have been trying to give you in a layman's language so that you can be aware, especially those with a non-financial backgrounds, you can be aware of meaning of an ROI, return on investment. Okay. So let's understand how do companies use the return on investment to evaluate which project needs to be undertaken. And this can be done better, can be understood better only by the way of an example. So we'll go back to our way. Let's say the company is doing an analysis of which project it should take up, which project should choose. It should choose. Okay. Now over here, let's say the company. Okay, let me first make it at 12. The company has a budget of $1 million. So that is the resource constraint. The maximum the company can spend on the project is $1 million. Now it can choose a combination of two projects or drop one or choose all three if the project requires only that maximum limit of investment. We'll see how it works out in now. Let's say the company is considering three projects: project A, project B, and project C. This will be project C, project B, and project A. Okay, so by taking these projects, the company expects an increase in revenue. This will be in absolute dollar values. By undertaking project A, let's say the company expects to have an increase of $500,000. Okay, 5 million. Sorry, $500,000. By undertaking project B, the company expects to have an increase of 5.5 million. And by undertaking project C, it goes for a $700,000 increase. Five zeros, right? Now this is the expected increase in the revenue. Okay, for that the company obviously needs to incur some cost, additional cost, or you can say additional investment to take the project, to undertake a project. For if the company wants to go for project A, it needs to shell out an investment of $400,000. For company B, let's keep it at somewhere around $420,000. For project C, let's say it's going to be somewhere around $500,000, so it's going to be $500,000. That's the additional cost or the investment which the company needs to make. Now notice over here, combining these three projects, the investment is 1.3 lakh. The company does not have a bandwidth to go for that level of investment. You can say the company can go for project C and project A, because here the project C seems to be promising in terms of absolute dollar values. Oh wait, let's just complete this whole table first of all. Net profit from the project in terms of dollar values is going to be simple. Expected increase in the revenue minus the additional cost. So sales minus the cost of the sales, that's going to be your increase in the revenue. Now, looking over here, you might be tempted to take up the project C because that has a profitability of $200,000 compared to project B and project A, which are seriously lagging behind project C. In fact, project A has just half the profit of project C. But let's not jump to conclusion first and understand the ROI percent on this thing. Now, how is the return on investment going to be computed? Return on the investment is going to be your net profit divided by your investment amount or the additional cost. Over here, we'll label the net profit as B and additional cost or investment as A, and it's gonna be a mathematical computation now. That is 100,000 divided by $400,000. That's gonna be 25%, I believe so. Yeah. And the same formula applies for this things over here also. So here it's going to be 31%, and for project C the return on investment is 40%. Now let's try to tweak the numbers a bit to see how the computation changes in terms of dollar value and percentage value. Over here it's simple enough. Project C is a first preference, project B is a second preference because it gives both a good return on investment and in terms of absolute dollar values also. Now let's say to undertake project C, the company will have to incur a cost of $550,000. Okay. So if you see, there's still project C has a profitability greater than project B in terms of dollar value, but the return on investment drops down from 40% to 27% just by an increase of a cost of $50,000, right? That is why the concept of ROI is very important to understand, guys. If you just go by the dollar values, absolute dollar values, you end up choosing a wrong project, which gives you a less profit percentage, less margin, less return on your investment compared to the other opportunities in hand. Let's say over here we do some maths for this thing also, project A, and we decrease the cost just by $20,000. Just by decreasing the cost by $20,000, even though project A has the least profit in terms of dollar value, still it becomes the number one preference because the return on investment jumps to 32% compared to the B 31% and project C, which is now worst at 27%. So I hope with this you understand the company's perspective of how they're going to select the projects based on the return on investment. They're not concerned with just the profitability figures. That's the next point for them. The first point is what is the project going to be generating in terms of the return on investment. And mark this thing, all the companies have an internal predefined set of a return on their investment. Let's say if your project generates 5% return on investment and the government bonds are giving a risk-free return of 7%. In that case, companies won't even consider your project. They'll directly put the funds which they can allocate to your project in the government bond because those are risk-free. It returns risk-free investment which are guaranteed to generate a 7% return compared to your project which is only generating a 5% in terms of financial policies. So that was all with regard to what is the importance of ROI, return on investment. Now we'll mark over here preferred projects in terms of their orders. Project A becomes number 1, project B becomes number 2, and project C becomes number 3. I'm sharing this template with you guys, this whole Excel sheet with you guys, and you can play around with the numbers and go and do a sum of more of your research to get a good understanding on the return of investment concept. Next comes the point is that why is it important for project managers to know the concept of ROI. So till now, whatever project this return on investment computation we've done, we had done it with the point of a company's point of view. How does companies use the projects, use the ROI to evaluate which project to choose? What is the point of understanding the return on investment for a project manager? Now, because as a project manager, you understand how the companies compute the various opportunities, how the companies compute the various projects return on investment and then choose the project. Before submitting your figures to the company, you yourself can do a certain analysis and certain cost benefit computation in the same style and figure out what unnecessary cost you can eliminate. Figure out what small increase in the cost, what small reduction in the cost can generate an increase in the revenue, can do a cost saving. As you had seen, when we just reduced the cost by 20,000 for project A, suddenly it became the most preferential project from being number 3 to being on number 1. So that's why it's important for you as a project manager to know what's the importance of those small cost saving also going to have on your project for being chosen in the long term, also for proving as a profitable project. So that was all, guys, with regard to the return on investment. I hope you get the good point about understanding what is the return on investment and how to do the various computation. Make sure you do have a thorough understanding of this. This is going to be a useful project not only in terms of your professional life but also in terms of personal life. How it can be useful in your personal life is that when you have certain investment opportunities, when you have an idle fund lying around with you and you intend to invest it, you can use the same return on investment concept. For example, a friend of yours who is opening a startup is interested in taking a loan from you, whereas on the other hand, you have a risk-free return from the government for 7%. Now that's how you determine which investment is a better one. Is your friend startup going to be generating that return sufficient in the future, or is it better to put the funds in the government-backed risk-free securities that are going to give you a safe and secure return on your investment as well as a principal? Okay, so I hope with this we have a good understanding of cash flow as well as return on investment. In the next session, we're going to see one more important concept, which is going to be capex versus opex, that is capital expenditure versus operating expenditure.